What is happening in the markets? Get ready, because the pace is unreal and we've got the must-know updates that are shaking things up right now. It's a whirlwind out there, and if you're not plugged in, you're missing out on the momentum that's defining the future. We're diving deep into the stories that matter, the moves that are making waves, and the insights that will keep you ahead of the curve. This isn't just news. It's your essential briefing for what's next, packed with the energy and information you need to stay in the game. From major institutional plays that are reshaping the landscape to critical market indicators that everyone's talking about, we're breaking it all down. We're talking about seismic shifts and strategic maneuvers that could redefine the entire ecosystem. Plus, we've got a look at some seriously surprising developments that could impact everything. Get ready for insights that could make or break your strategy. Don't blink, because this is the Bitcoin Bulletin, and we're about to give you the download on the most electrifying updates you'll hear all day. Stick around, because you won't want to miss a single second. Make sure you're subscribed and the notification bell is on so you never miss an update. Institutional footprint expands. The digital asset space is witnessing a significant evolution as major players continue to integrate and transact within the ecosystem. Recent activities from BlackRock, a titan in the financial world, highlight a growing institutional embrace of digital assets, signaling a potential paradigm shift in how traditional finance interacts with cryptocurrencies. These transactions are not merely isolated events. They represent a broader trend towards the institutionalization of digital assets, embedding them more deeply into the global financial infrastructure. This move by BlackRock is being closely watched as it could pave the way for increased adoption and liquidity, potentially unlocking new avenues for investment and asset management. The implications are far-reaching, suggesting that digital assets are moving beyond their speculative origins to become a more established component of diversified portfolios. Analysts are keen to understand the long-term strategy behind these moves and what they portend for the future of finance. The transparency and volume of these transactions provide valuable data points for market participants seeking to navigate this rapidly developing landscape. The involvement of such a prominent institution lends a degree of legitimacy and stability to the digital asset market, potentially attracting further institutional capital and fostering innovation. This narrative of growing institutional interest is a key theme in the current market, reflecting a maturing ecosystem ready for wider integration. The digital asset market is a dynamic environment, constantly shaped by technological advancements and evolving regulatory frameworks, and institutional adoption is a critical factor in its ongoing development. The ability of these assets to offer diversification benefits and potentially higher returns continues to attract attention from sophisticated investors and asset managers globally, eager to capitalize on the opportunities presented by this new financial frontier. The ongoing integration suggests a future where digital assets are not an alternative, but a fundamental part of the financial mainstream. The sheer scale of BlackRock's operations means that even small forays into digital assets can have a significant ripple effect across the market, influencing sentiment and driving broader adoption trends. This institutional momentum is a powerful indicator of the growing maturity and acceptance of digital assets within the established financial system, promising a more interconnected and innovative future for global markets. But what does this mean for the broader market sentiment and the future of digital asset integration? Stay tuned as we break down the next major development that could send ripples through the entire tech sector. Merger fuels Nasdaq ambitions. A significant strategic move is underway in the corporate world, poised to reshape the landscape for companies seeking to engage with the digital asset sector. Gryphon, a notable entity, is set to merge with American Bitcoin, a development that has immediately captured the attention of investors and industry observers alike. This union is not just a combination of two companies. It's a calculated step designed to propel American Bitcoin towards a highly anticipated listing on the Nasdaq stock exchange under the ticker ABTC. The implications of such a listing are profound, potentially opening the doors for greater mainstream financial access and investment in companies deeply involved with cryptocurrency. For Gryphon, this merger represents an opportunity to leverage American Bitcoin's existing infrastructure and market positioning to achieve a more prominent public profile. For American Bitcoin, it's the culmination of efforts to align with a strategic partner that can facilitate its Nasdaq debut, a move that could significantly enhance its visibility and credibility within the broader financial community. The Nasdaq is renowned for listing innovative and growth-oriented companies, and a successful listing for American Bitcoin would signal a major milestone in the journey of integrating digital asset-focused businesses into traditional stock markets. This development is particularly timely, as there is increasing investor appetite for exposure to the digital asset economy through regulated and accessible channels. The merger is expected to streamline operations, enhance market competitiveness, and provide a robust platform for future growth. Analysts are closely monitoring the regulatory hurdles and market reception that will accompany this proposed listing. The success of this merger and subsequent listing could set a precedent for other digital asset companies aiming for similar public market access, potentially democratizing investment in this burgeoning sector. The strategic rationale behind this combination is clear: to create a more powerful entity capable of navigating the complexities of both the digital asset space and the public markets. This fusion is more than just a corporate transaction. It's a strategic maneuver aimed at unlocking significant shareholder value and establishing a strong foothold in a rapidly evolving industry. The market is keenly observing how this partnership will translate into tangible results and influence the broader trend of digital asset firms seeking public market validation and capital. The path to a Nasdaq listing is often challenging, requiring adherence to stringent financial and operational standards, making this merger a testament to the parties' commitment and preparedness. This move could also signal a broader acceptance of digital asset-related businesses within the traditional financial system, paving the way for increased innovation and investment. Could this strategic alliance unlock unprecedented opportunities in the public markets? Prepare yourself for a deep dive into market dynamics that are creating a potential surge in value, with predictions hitting sky-high numbers. Supply squeeze on the horizon. Market watchers are keenly observing a significant shift in Bitcoin's supply dynamics, particularly concerning the amount of the cryptocurrency held on the Binance exchange. Recent data indicates a notable surge in Bitcoin's illiquid supply on Binance, a phenomenon that has analysts buzzing with speculation about its potential impact on the price. Illiquid supply refers to the amount of Bitcoin that is not actively traded or readily available for sale, often held by long-term investors or in cold storage. An increase in this metric on a major exchange like Binance can suggest that fewer sellers are actively looking to offload their holdings, potentially leading to upward price pressure if demand remains constant or increases. This trend is particularly intriguing given the prevailing market sentiment and ongoing discussions about Bitcoin's potential to reach new all-time highs. The current narrative suggests that if this illiquidity continues to grow, it could create a supply squeeze, driving the price of Bitcoin significantly higher. Some forecasts are ambitiously projecting Bitcoin to reach $150,000 by the end of the year, with this increasing illiquidity being cited as a key catalyst. This projection is based on the principle that as the readily available supply dwindles, buyers will have to compete for the remaining Bitcoin, bidding up the price. The implications for investors are substantial, as it could signal a period of accelerated growth and significant returns. However, it's crucial to consider that market dynamics are complex, and while illiquidity can be a bullish indicator, it's not the sole determinant of price action. Other factors such as macroeconomic conditions, regulatory developments, and broader market sentiment also play critical roles. The concentration of illiquid supply on a single exchange, while significant, also warrants attention to how it might interact with supply held elsewhere in the ecosystem. Nevertheless, the current data points towards a tightening supply environment, which historically has been a precursor to price appreciation. This development is a key indicator for traders and investors looking to position themselves strategically in anticipation of potential market movements. The conversation around Bitcoin's scarcity and its potential as a store of value is amplified by these supply-side observations. The growing illiquid supply on Binance is more than just a statistic. It's a potential signal of conviction from holders, suggesting a belief in Bitcoin's long-term value proposition. This could be a critical factor in driving the market towards the ambitious price targets being discussed, marking a potentially transformative period for the digital asset. Is this surge in illiquidity a sign of true conviction, or is there another side to this story? We're shifting gears to a story that's a stark reminder of the real-world risks in the crypto space, with a case that's sending shockwaves through the justice system. Justice served amidst crypto crime wave. In a stark reminder of the dangers lurking in the digital asset world, a recent court ruling has handed down a significant prison sentence to a ringleader involved in a series of violent home invasions targeting cryptocurrency owners. Ramai St. Felix, age 25, has been sentenced to an additional 7 years in prison, adding to his already substantial 47-year sentence received last September. This extended punishment stems from his brutal assault on a witness who testified against him in the original home invasion case. According to the U.S. Justice Department, St. Felix attacked the witness, who was in detention and restrained, striking them repeatedly in the face, head, and body. During the assault, he reportedly called the witness a rat and blamed them for his lengthy original sentence. This act of retaliation occurred after St. Felix had already been convicted on 9 counts, including kidnapping and brandishing a firearm during the commission of violent crimes. In May, he pleaded guilty to a separate charge of retaliation against a witness, which resulted in this additional 7-year sentence. However, 36 months of this new sentence will run concurrently with his previous sentence, effectively extending his total time behind bars by nearly 4 years. This case shines a spotlight on the increasing prevalence of wrench attacks, a disturbing trend where perpetrators resort to physical violence and brute force to steal cryptocurrency, bypassing sophisticated digital security measures. The pattern has been particularly alarming in Paris, where victims have reportedly had fingers severed while being held captive, leading to numerous arrests, including that of a suspected 24-year-old mastermind. Another wrench attack was also reported in France this past week, underscoring the persistent nature of this criminal activity. In one particularly harrowing instance linked to St. Felix's crew in Florida, a victim was abducted from their home, driven 120 miles, and assaulted while being held hostage. In another incident, a Texas family was held captive for 3 hours, during which their cash and luxury watches were stolen. St. Felix was initially charged alongside 13 co-conspirators, with authorities estimating the group stole a total of $3.5 million worth of cryptocurrency. He was also ordered to pay $524,000 in restitution for the stolen assets. Another associate, Gerard Gabriel Simungal, received a 20-year prison sentence and was ordered to pay $4 million in restitution for his role in providing the team with rental cars, hotel rooms, and firearms. This case serves as a critical warning about the physical risks associated with holding significant amounts of digital assets and the lengths to which criminals will go to obtain them. While this criminal element is a harsh reality, the digital asset world continues to innovate and evolve. Join us next time as we explore the groundbreaking advancements that are set to redefine the future of digital finance. And that's a wrap on today's electrifying updates. We saw BlackRock deepening its involvement in digital assets, Gryphon and American Bitcoin merging with Nasdaq listing ambitions, Bitcoin's illiquid supply on Binance hinting at massive price potential, and a harsh sentence for a crypto crime ringleader. Don't miss out on the next wave of market-moving news. Hit that like button, subscribe to Bitcoin Bulletin, ring the notification bell, and let us know your thoughts in the comments. Follow us on all social platforms for real-time updates. We'll see you on the next one.